So to really understand what's going on in services, why is services the sticky component that's causing these elevated CPIs, and then why did it surge in the July print and drive that 0.9% month on month? That's where you have to go into the breakdown within the services components and look at what's happening. And it's not just all one segment of services. Cameron, if you're at slide 7, this is a kind of a breakdown illustration of what a broker dealer sent me this morning on their analyst first assessment of the PPI results. If you look at like what's up, right? That second line, the green shaded bars, portfolio management services, up and to the right, swinging from a -5 points or in excess of -5 percentage point contribution in terms of that particular type of service in the overall economy back in April on Liberation Day. And if you recall what was going on there, markets were selling off. Well, now in July, that number is the big swing, and you see that big green bar furthest to the right. That's portfolio management services, just a guy managing some funds. According to this data series, um, things like that, investments, data services, stuff like that, is a key driver of this PPI. It makes no sense relative to tariffs for this to be the first wave, but if you think about how trade like how these flows kind of propagate through society and actual costs increase in response to some sort of shock or event starts first from the money center, right? The first assets to respond, if they're financial assets, right? And I have on slide 8 from a portfolio management standpoint, going back to 2002, the portfolio manages management services component of people really just proxies the S&P 500 index. So the first step on, say, cost rise in the economy, that's somewhat synonymous with saying prices are up or price levels are rising. If you look at services, they're the fastest to respond. Why is that? Well, goods trade, you have to move them, you have to work through supply chains, they're very complicated. Services, there's a lot of segments in here that are very hyper responsive. And if you think about a portfolio manager, right? If he's earning some like a fixed rate that's applied to the price of the S&P 500 index, the S&P 500 index, the information will flow fastest with the smallest amount of friction into those prices, which will carry portfolio management services higher as like the first to reflect. Now, for the next wave of services, if it hits goods, a new washing machine, things like that have to work their way through supply chains. You have a lot of purchase orders, a lot of transportation, a lot of steps in a manufacturing process for that to, fully work its way through. So if I'm a policymaker and I'm looking at this PPI report today, um, I'm gonna want to dive deep into this and understand what's going on. When I say that, I mean FOMC, um, Washington D.C., New York City, the key players who um, are responsible for the centralized management of the monetary system and the trickling down from the financial economy into the real economy. This is where you do not want to make a mistake. So if this PPI index and hitting services first represents kind of the first wave of the shock kind of propagating everything we've seen since April, this is something I think you want to be very careful about. And if we get this decision wrong, as far as whatever we do as far as monetary policy going forward, could have some pretty significant repercussions over the medium and long term. So really important like stretch of the journey we're traversing here. It looks like heading into the September FOMC meeting, middle of the month, we're very likely to get that rate cut. That's been very, very much so, and not hiding at all, pressured for from the executive branch of the federal government. This is one of those things where you might want to be careful what you wish for. We're in a spot where, as we mentioned, the energy market, as far as oil and gas, is signaling softness in terms of growth. It'll want that rate cut. The rate cut would potentially be welcome there. But in terms of the price level situation, whereas we've so far, 3 or 4 months in, the general response has been, look, no inflation. Um, we're good. We're in the clear. These things take time to play out. So this is one of those situations, in my opinion, you want to be careful playing with matches.